Good morning, good afternoon, good evening, wherever you are around the world. It is Sunday. It is May 22nd. And this is going to be our weekly review and chart preparation for what is sure to be a very interesting week of trading. I want to apologize to the group of guys I usually meet with in the morning to go over this because it took me about 2 hours here to get my mic figured out here. I don't know what was going on. Had some usual technical difficulties. But we are back and we are ready to rock and roll. So we're going to take a look at the market, some of the things that we noted from last week, what we're expecting going into this week, talk some of the earnings, the economics, everything that we have laid out before us in this coming week. We have now finished options expiration. So we've kind of hopefully unpinned ourselves from this range. We saw some pretty crazy trading action last week. So going into Monday, we had some nice movement. We had kind of the inside day followed by the gap up. We breached, and then that got immediately bull trapped and smacked back down. And this kind of action that we've been seeing, this is something that if you haven't noticed it yet, you're not really looking and you're not paying attention. We had a complete smackdown here. Every time we would get ourselves back up and look like we're breaking out, smacked back down. Look like we're breaking out, smacked back down. And the Fed squeeze, smacked back down. And we just had another similar kind of action. And in these big red bar days, I mean, when we have a red bar, we have a red bar right now. I mean, we haven't seen really a tiny red bar minus Friday, except prior to kind of this whole second leg down. So we see serious demand destruction out there. And we're seeing some serious headlines. And has the narrative changed long term yet? I don't think so, personally. Now, we're going to talk both long term and short term here because there's a lot going on. All right, Sweden and Finland officially submitted their NATO application. Now, no one is expecting much from that yet because Turkey has come out, laid out their list of demands in terms of I'm sure there's a lot of backdoor meetings that we don't know about, discussions that we don't hear, and so we don't really know what's going to happen with this application. Obviously, NATO would like to fast track the approval for Sweden and Finland. But Turkey's still kind of there, and they refuse to ratify it. They need a unanimous vote, and Turkey has some demands that they would like met first. So we'll have to listen to see if anything like that comes out this week in terms of one way or the other, because that is something that could potentially cause escalation or de-escalation with the Russia situation. That is another thing that, again, the market isn't really moving on headlines from that because we've kind of have our set, pricing in at the moment. Nothing's changed yet. No narrative has changed there. China, meanwhile, that's going to be another thing that we really need to listen to. Yes, they still have the Taiwan situation. We don't see that escalating until at least their lockdowns are done. I'm more focused on the lockdowns personally. Are these going to end? Is this COVID-0 policy going away anytime soon? Or is this going to continue to screw up supply chains? And as they're currently starting to reopen and lighten up a little bit. If that does happen, now suddenly this port congestion centered around Shanghai, those ships are going to then start flooding outwards. And we're going to probably see some serious port congestions yet again on our west coast in Europe and all the other major ports around the world. So that's going to be further supply chain issues that we need to listen for. Some other headlines out there that we're going to be listening for and trying to get a good gauge of is we get some inflationary numbers this week. Goldman, a lot of people out there, even the Fed, largely kind of sticking to their guns saying that they believe inflation has peaked. Is that true? Or is inflation peaked in goods and now are we going to see it in services a little more? What's going to happen out there? That is some serious questions that we need to be paying attention to because that's going to dictate Fed policy going forward. We also need to listen to any kind of labor numbers or any kind of labor talk that we may see out there or consumer talk because those are also very important to the market right now. So that's a lot of stuff that we need to be juggling right now to get a better gauge of the expectations from the Fed going forward. We have yet to really fully price in a recession expectation. So as that narrative continues to develop, that's something that we need to continue to price in. Monkeypox is a thing. It is currently still spreading. So that is something in the background. Yes, it is likely to be a non-event. It's a lot harder to spread, supposedly. So I'm not expecting some new pandemic, but we could get fear from that if it does continue to spread. If suddenly, people start freaking out, they're not going to want to sit through a potential repeat of last March. So you could see a little little extra fear bump there that could trigger some stops and flush out some dip buyers. So just listen. I mean, New York just had its first case, and that's a pretty condensed city over this last weekend. So that is some stuff that we need to continue to listen to and just track as we go. But other than that, it's been a relatively quiet weekend. So taking a look at the action here, I mean, we had a serious breakdown on Friday. Now, Friday was options expiration, so you need to be careful with how much you're looking at this price action and trying to suss out in here, because when you get options expiration, you get a lot of funkiness. People end up, their options expire, or they're trying to hedge their options really quickly, or they're trying to cover their hedges. So there's a lot that happens when these options are expiring, as people are as their options are exercised and as things move. So that's just, there can be a little funkiness here. But this again was serious demand selling. We never, until we finally, got this kind of temporary bottom put in at 381, we never really saw any indication that there were dip buyers in here. And so this is still a shaky market where people are not quite eager to dip buy. Now this 380-ish, 381 that we bounced off of, a little bit of an inflection point from the beginning of 2021. SPY has yet to take out its 2021 gains. That's why I think we do still have more lows ahead of us. I don't think we've put in a permanent bottom. We could have put in a temporary bottom if now that options have expired, if we get a short cover, or if bulls decide to squeeze back in. But there are still a lot of people who are looking for that, so you got to be very careful. Don't be a hero in this market. That's the long story short. You don't need to try to catch tops and bottoms. That's how most people blow up. Don't try to be the first to buy. Let price action dictate. You didn't need to buy here to make money on this squeeze. You didn't even need to buy here. You could have bought here on the crossover of the 50 or the 200. There's still money to be made. Just whatever kind of dictates for you that you can manage your risk, that's going to be what's important, because I don't think we've reached low, our all-time lows yet. I think there's still a lot to watch and monitor, but we'll have to see. So that's a pretty telling thing to see. Now, we did dip by it. We did finish up, which could be interesting. That could be interesting. We're going to have to see how Monday shakes up. If we do start ascending, I'd like to see us, really get back up in the upper half of last week's range, really, maybe closer to this 400 before I'd even be curious to see what we do. It's a little choppy here, though, where we are in the SPY. So I'd look to the Qs maybe to get hopefully a little bit of a better example here. The Qs did break for new lows as well. If I zoom out, I mean, Qs are quickly approaching some serious levels here. They're 200 weekly moving average here, and also some pretty significant support sitting around that 260 or so. So even if we do start breaking, there's no reason to buy until we get to a major level and we actually see buyers accept prices at that major level. We just had 7 straight red weeks. This is getting to some record territory here in terms of consecutive weeks red. So that is also something that we need to pay attention to. As a bit of a mean reversionist myself, maybe we could see a squeeze or a snapback at some point. There's a lot of cash on the sidelines. There is a lot of dry powder in this market. It is a very illiquid market. The futures are very illiquid, and that could be true, and that takes note, for both the upside and the downside. All right, an illiquid market can squeeze up. It can also drop very seriously and very easily. Okay, so that's what happens when you have this illiquidity. So just be careful and watch this price action, because I could see us squeezing just for the fact that we've had these consecutive red weeks, and the fact that we are pretty far off of these lows and pretty extended from the 50-day. But until I see that price action, I'm not going to be the first to step in. IWM, meanwhile, holding up a little better than the other two. So this is going to be an interesting one to watch. I think this is largely because it's already kind of hit its pre-COVID highs. We're getting a little bit more of a moment here, a momentary pause. A lot of the small caps and kind of the companies in the IWM, I think they have a rough road ahead of them as we raise rates. And as rates continue to rise, a lot of these BS zombie companies in the IWM are going to struggle. But these companies have already underperformed the market. They're already selling. What we're looking at is the big cap stocks. These are the ones that are underperforming right now. Apple, Tesla, Microsoft, Google, these guys that were holding up previously a little better than the rest of the market, and clearly there's a lot of institutional ownership here, they're starting to get hit. That should concern you, because if more big money starts pulling out of these big cap stocks, these are the guys that will drag down the market even further. These are the guys that will pick up the slack and drag us down for another leg, even if the rest of the stocks don't really move. These are the ones that control the market movement. So if we do start to see them continue to hit these companies, no one is safe in a bear market, and they're just starting to come for Apple. Apple's just started this sell-off. This is a very interesting level. I'm very curious to see where we go from here. Very interesting support level, but if we break this, I'm not looking again until 120, and then not again until 106, and then 100. You've got your levels, but we're still very elevated in many of these stocks. Look at Microsoft. We're nowhere near the 2021 open. Same with Apple. Tesla just finally getting hit. Still has a lot it can give back. We were at pre-COVID highs of 176. We're still 500 points higher. Be careful, okay? I know it looks very appealing. Think if they're not going back to highs anytime soon, okay? So get that notion out of your head. And they're just starting to hit. This is probably tough times ahead for some of these companies, and they can drag the market down. So that's a little bit of a bigger narrative this week. We're going to see what we get. What are some of the numbers and some of the economics coming out this week? Monday, not really much. It's going to be very, very quiet. It could be light on volume. We could see a bit of a chop, or we could just resume our scheduled program of selling. Tuesday, you get PMI composite flash, new home sales. We are starting to see some cracking and some fracturing in the housing market. It is very unaffordable in the housing market right now, and we are starting to see a slowdown there. That is something that I do want to continue to monitor because housing is very unaffordable right now for a lot of people. Two-year note auction Tuesday. Okay. Wednesday, you have durable goods orders. I don't expect that to pick up anytime soon. Buying expectations and buying intentions out there for large ticket items, very, very low. People are more spending on services right now. Petroleum numbers, 5-year note auction, and at 2 p.m. we get the FOMC minutes. That could be pretty interesting if it shows any kind of additional light in terms of expectation of increasing tapering, or sorry, not tapering, but of their roll-off of the balance sheet or anything like that. That could indicate that we could get a more hawkish or dovish Fed in the near future. That's what we need to look for. You get a little bit more of a sussed out picture of the previous meeting. Wednesday, you get that GDP number. This is still kind of finalizing last quarters, so I'm still waiting to see, when that next advanced number for GDP comes in to see, do we have a technical recession coming? Jobless claims. We are starting to see a little bit of wiggling and a little bit of fracturing in the jobs market. Still have a long way to go before you can declare that this jobs market is broken and cooling off, but that is still a number that we need to start paying attention to again. Thursday, you also have pending home sales. Again, more of that housing number, nat gas reports, 7-year note auction, and the Fed balance sheet. Friday, that's going to be a very interesting number because you get the PCE deflator number. That is the Fed's favorite inflationary measurement. That is going to be something that the Fed is going to pay attention to. You should pay attention to. I would argue it's more important than CPI and PPI. Watch that number on Friday. International trades in goods and services advance numbers, as well as consumer sentiment and retail inventories advance. Retail inventories could be interesting. We saw some very interesting stuff from Target's earnings in terms of how terrible their situation looks going forward. Same with Walmart. They have very high amounts of inventory levels, which is a problem because they can't lower costs to get rid of that inventory because their margins are being squeezed right now. The margins for these companies is getting squeezed. Their EPS reports are getting way lower than we're expected to be, and they can't lower prices to move that inventory, so they're just going to have to kind of grin and bear it. They can't raise prices really to combat that because of how these companies are situated, and because they already have a lot of inventory, so they can't fracture the sales. Consumers are out there, they're swiping their credit card, they're spending more for less, and that's something that we need to continue to monitor. So the earnings were a big deal in my opinion before I continue to move on here to some of the commodities, because we saw when Netflix imploded, this was a big institutionally owned company, and this caused a bit of margin selling in my opinion, because this is where Netflix reported earnings. Look what happened after. The narrative shifted. We started seeing these once impervious growth stock companies getting crushed, and stocks where institutions were hiding at and other large firms were hiding in getting obliterated and having to sell, and margin calls could be hitting out there in companies we wouldn't know, but if they do, they're going to be selling their winners to cover those losers and to hold these positions or to fix their account balances, and that causes further cascading in strong stocks like Apple and Tesla, who we're starting to see get hit. You got groups like Tiger Capital and Melvin Capital pretty much just folding up because they're losing so much money in this market. So that's just further selling pressure. So we saw that again with Target's earnings. Target and Walmart. Look at these stocks. This isn't retail selling. Okay, yeah, sure. I'm sure there is retail in there. This is not retail volume. This is big boy volume, and this is big boy volume crushing and obliterating a stock like Walmart and Target that haven't dropped like this in decades. So when these guys sell and you start seeing the big boys start getting hit as well, that's institutional money pulling back the reins, getting a little bit more cash heavy and going into dry powder. Now, does that mean that they could buy in for a squeeze? Maybe. Yeah, sure, it could happen, but this is still something that we need to watch because we do have some more earnings this week. So let's talk about some of the earnings that we have coming up this week. XPEV is going to be Monday morning. It's a China EV play. I'm not too interested. Monday afternoon, you have Zoom. Good luck, Kathy Wood. If anyone here actually believes that Kathy Wood stocks are going to take a rebound, God bless you. Zoom, Advanced Auto Parts, Skyline. Yes, some small companies here and there. Tuesday, you get more retails, so you get Abercrombie and Fitch, you get Best Buy. Very curious to see how Best Buy is going to do. We're near COVID lows here. Veru, Ralph Lauren, Wolf, which is Petco. You get a couple companies like that. You also get CSIQ, which is a solar company. Tuesday after close, Nordstrom, Toll Brothers, Little House Builder, and Urban Outfitters, as well as Allegiant. And then Wednesday, you get Dick's and Express. So two more retail earnings here. Wednesday after the close, you have NVIDIA. This could be an interesting one. This could further shed light on how tech and growth stocks are doing. Going to be very important Wednesday after the close. Guess, Snow, another big tech company, SPLK, and William and Sonoma. And then Thursday, we get a lot more companies. We're starting to get some China plays as well. See how China's been doing with these lockdowns. Baba, Baidu, what's this? Build-A-Bear. That's a little meme play. IQ, another China play. Macy's, MDT, Medtronic, a little healthcare. Dollar and a Dollar Tree, which I always joke is dollar and a half tree. Look what happened to some of these stocks after Walmart and Target's earnings. That they report, Costco reports Thursday after the close. We're getting more of these companies, and if they all continue to miss, it could get even uglier for some of them. So just be careful. Stocks like WDay and Ulta and Dell and Autodesk, American Eagle. Friday you have Big Lots and a marijuana company, but I don't expect anything there. So we do have some larger retail earnings, and with the consumer spending like they are, these are some of the guidances that we're going to want to pay attention to get a better, fuller picture of what's going on. So that's kind of our situation going into the week. What are some of the commodities doing? Well, oil and gas, they are still starting to pick back up. Oil's been a very good technical trader on a long-term picture here. They've continually started ascending with kind of these lower highs. We are still kind of curling up here. There is no reason to expect oil to not continue to have a bullish thesis, especially if China opens back up. That is a lot of demand that is going to drive up this price. So just be very careful with oil here, and this is something that can continue to affect a lot of companies. So I don't expect any slowdown in oil yet until we get any kind of narrative change out there. Gold is starting to pick back up. It is finally kind of broken out of its downtrend here, and we could see a little bit of a nice base, maybe being put in here, kind of a nice little inflection point. Now that we're starting to ascend, maybe we see gold pick back up. But something that we have to watch both for the market and for gold is going to be the dollar. We're finally seeing it kind of pull back a little bit here. Are we going to start to form a head and shoulders? Are we going to spend this week chopping? Are we going to see the strength come back in because the dollar was a flight to safety for a little bit there? If that does start to weaken, it could give a little bit of bounce potential for some other plays like the market or like gold. One other thing I wanted to mention, by the way, is that bonds didn't drop off. Friday. So that is a big tell right there, in my opinion, that Friday's action was probably more just geared to some selling, panic selling, maybe some stops getting hit, maybe more the options expiration. So we definitely need to continue to watch high yield growth bonds and junk bonds. These guys have really been the ones that have been leading us lower. And if they do start to roll back over, them in the stock market, they have diverged, but it's only going to last so long. These are the guys that have been pricing in more pain here. So continue to also watch the treasuries and their rates. We are seeing rates come off a little bit. So this is some stuff that's maybe pointing to more of a choppy week next week, maybe a bit of a bounce week. But if this stuff turns around and we see a reversal, be careful. So that is some more stuff that I'll be watching as well. Going forward. And then last but not least, crypto and Bitcoin. I mean, these guys, they look like garbage. This is something that if we do see crypto continue to drop off, over 50% of crypto holders are underwater now. If we get margin calls here, if you get liquidations in crypto, they could also pull their investments in the market. No one's just invested in crypto or just invested in the market. You get a lot of bleed through, and they can affect each other. In fact, right now, crypto is trading very closely with the market. Just be careful here. You saw what happened to Luna, and you see what's happening in crypto. They're looking weak, and it's depending on if we break this flag this week, it could be very interesting. So you do have big margin call levels to watch in these spots. So that's kind of the commodities out there. That's your market. That's your situation. Some of the stocks I'm going to be watching, I think you can probably guess a lot of them. It's going to be the same kind of stuff. We did get consumer staples absolutely obliterated last week. This was also something very impactful to watch. Continue to watch utilities. That's the only defensive play that's really holding up right now. Even the war plays are starting to roll over. I think we get some nice short opportunities in guys like Lockheed Martin Martin, in Northrop Grumman, in some of these plays that are really starting to, I think we're a little bit of a hideout for some companies. I think if we start to see money being pulled out here, it could definitely impact how quickly we drop on some of these plays. So you did have some interesting movement out there, especially in these consumer staples. I mean, look at the food plays: PepsiCo, Tyson, Coke. Some of these guys got smoked. So I'm definitely be watching these very, very closely this week, and I'll be trading accordingly. There are some movement stocks like Sega, a little monkeypox play. This was a great Momo play on Friday. Called this one out in the morning video. Look at the follow through we have in the after hours. Haven't seen a great play like this in some time, since during the bull market last year. So maybe we get some nice day trades out there on some of these plays. I'll obviously watch second day plays, and not really second day, but follow through plays on stocks like Target and Walmart, Kohl's, BJ's. A lot of these retailers got obliterated on Friday. Look at Deere. So I'm going to see what we get on some of these, if the selling continues or not. You do have a lot of consolidation plays that I'm watching to see if they break. Coin has been flagging here. ARC's even still flagging, though I could see a bounce in ARC, frankly, but we'll see. Cisco had earnings. AT&T continues to look strong, as does Pfizer. I like both of these plays still. I've kind of mentioned them. It's going to be hard if the market does start to just implode. It could weigh down on them a little bit, so just be careful. Nothing is immune, but that's going to be interesting. Obviously, I'm also going to want to watch the China plays as we go into their earnings. I think we could get some interesting movement here with what's going on. And then we'll just take it day by day. We'll have the morning videos. We'll go over what else is going on out there. But it's going to be an interesting week. I don't have a good gauge in terms of, are we going to sell back off this week? Or are we going to chop? Or are we going to pop? After options expiration, I think I need to see how Monday goes. Because, now that the dust is settling, who's left? Who wants to buy? Who wants to cover? We've so far survived the weekend without any headlines, which could maybe give a little bit of confidence to dip buyers. But we've seen what's happened to dip buyers in this market lately. So we just got to be careful. But risk management is going to be the name of the game. That's how we're all going to survive, and that's how we're all continue to make money together. But anyway, I'll see you Monday through Friday at 8 a.m. Eastern-ish for the morning market analysis. And then Monday through Friday at 1 p.m. Eastern, I'll see you all there for the Vant Rant podcast. We'll talk about all the stocks in play. I really appreciate you all for tuning in for me today. Get ready, rest up, enjoy the rest of your weekend, and as always, safe trading.